This is probably one of my most overdue videos. I'm going to be discussing why I am bullish on Chinese stocks, even though the fear and pessimism seems to be at a peak here in the US when it comes to addressing China's economy and its impending collapse. Look, I'm not going to deny that China's economy is in a very bad state right now. They're already coming out of a recession, not only because of their COVID crisis, but also because of their massive home oversupply, which has led to so many prices coming down and resulting in a lot of losses for residential consumers. But all I know is that the US is way too dependent on China to make it just go away and be completely ignorant about what's going on in Asia's largest economy. And those reasons are exactly what I'm going to address in this video. But as usual guys, before you get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's actually understand what's the situation of the Chinese stock market. I think a lot of folks don't actually even know what this index is, but this index basically tracks the biggest companies on the Chinese stock market exchange, including the Hong Kong exchange, which I'm sure you guys have heard about. And as you can see, over the past 5 years, this index is down 39%, significantly higher than the S&P 500 is down even just in 2022. And obviously this insanity is driven by multiple things. We've had the tech crackdown because of Alibaba and Tencent, and now we've had the property and mortgage crisis followed by the Evergrande default back in September of 2021. And so based off that information, it seems like investing in China right now is probably one of the worst decisions you can make as an investor. But in this video, I want to give you a contrarian perspective to this very popular opinion, at least in the West. And the simple reason for that is because the Chinese economy has been through this volatility many times over the past 30 to 40 years. You can clearly see that in the Hang Seng Index. This index has seen drawdowns of over 50% in a span of a year to 2 years. And this is something we're simply seeing right now, which is exactly what has caused this recency bias in the West about how China is just a bad country to invest in and that the Chinese economy is indeed going to collapse. And as you can see, over the very long term, the performance of the S&P 500 and the Hang Seng Index are not actually that far off. The Hang Seng Index is down over 60% and it's up 544% over the past 40 years, whereas the S&P 500 is up 712%. And that is obviously because the S&P 500 only started collapsing at the start of this year, whereas the Hang Seng started all the way back in 2018. And the reality is that is simply how the market works. There's always peak pessimism and fear at the bottom of the stock market, which is obviously when most people get shaken out, which in hindsight is obviously always the wrong decision because the trend in this index is indeed to the upside. Even if you focus into the technology sector of China, this sector has seen a lot of volatility over the past decade, but the trend has still been to the upside over the long term, even though at these peaks and troughs, it always seems like there's peak pessimism in the media and that China is always the bad thing to invest in. And to be honest, that is something we should expect from an economy that is so young and growing at such a fast rate. The volatility simply has to go up because the US is obviously significantly more established and mature than an up-and-coming economy like China. And so these ups and downs should not be that of a surprise. Instead, they should be looked on as opportunities for opportunistic and long-term minded investors. Folks are really underestimating China's manufacturing capability and the massive technological enhancements they've seen over the past 5 years. I mean, think about it. Not only can these guys make stuff for cheap and scale it up significantly, but over the past decade especially, these guys have seen insane technological enhancements, specifically in the EV and automotive sectors. And I think Michael Burry did a very good job of summarizing this in one of his most recent tweets. China is simply seeing an America in early 2009 kind of moment where we saw so much pessimism in the media around how the American economy was going to collapse because of the real estate bubble. And even 2 years later, in 2011, we still saw so much skepticism about the ability of the American stock market to actually recover. And as we've clearly seen over the past 10 years, the market has recovered significantly from even the highs it made back in 2007. I mean, let me put it this way. The electronic device you're watching this video on right now was probably manufactured or assembled in China. And if not, any one of the chips or electronic components within that device were indeed most likely, in a 99% chance, manufactured in China. And the reason is pretty simple for that. It's very easy and cheap to make stuff in China. And as technologies become more advanced, it's going to be a bigger and bigger requirement for companies to be able to commercialize them at a cheaper price. And that's a big reason why, even though the US and China relations have been deteriorating over the past 5 years, from an actual technological standpoint, trade has actually gone up between the two countries over the past 5 years, where now we do roughly $590 billion in trade annually together. As a matter of fact, the US's largest trade deficit is actually with China. And even after the tariff war from 2018, the US is still exporting less goods than it is importing goods from China. As you can see, especially in the pandemic, this number spiked, which is obviously as a result of high inflation in the US and comparatively low inflation in China, which again goes to show that their government is significantly better able to manage inflation and monetary policy because of their obviously different government style. And the largest source of foreign input in US goods and services is indeed from China, followed by Canada and Mexico at $400 billion annually. Meanwhile, on the other hand, China is actually significantly more diversified for its goods and services. It does rely on the US as its number one spot for inputs at around 1.1 trillion, but it also has Japan lined up right next to it, which is again another country that is very efficient at manufacturing and commercializing nascent technologies. But obviously that doesn't tell the whole story. It's important to look at the China and US economies from a consumer standpoint as well, and not only from a macroeconomic standpoint. And as you can see, the data is showing us that since January of 2020, consumer sentiment in the US has actually declined much more than it has in China, which is overall a good thing because it means that the Chinese consumer is more confident in their ability to spend and in the long-term prospects of their respective economy. And what is a big reason for this? Well, because the Chinese household on average has around 4x the amount of savings than the typical American household. And the good thing is that these guys are also significantly less inclined to spend money on useless things than the American household. But it definitely seems like US regulators and Chinese auditors both understand that this relationship between those two countries is very important. So they are trying to come at a crossroads and meet in the middle, which again for me is a good sign of recovery in the US-China relationships, which again should result in some better stock prices for Chinese investors. But that's not all of it. The most important and impressive thing about China is that despite them being one of the fastest growing economies for their massive GDP, they've experienced extremely little inflation over the past year. As you can see, the US has experienced 8.3%, which is significantly lower than Russia, but China is all the way at the bottom of this list at around 2.1% inflation over the past 1 year. And keep in mind, this is with GDP growth expected at the low end of 2.5% in 2022. To put that into perspective, the United States GDP growth for this year is probably going to be negative 60 basis points or negative 0.6%, which obviously is very, very bad given that inflation is already so high. And a big reason for this is because the Chinese yuan has been historically weakening over the past 1 year, primarily driven by the very, very strong US dollar. And so as a long-term investor, there's probably never been a better opportunity to buy into Chinese stocks if you understand the long-term vision that that country holds and its businesses hold in the form of their technology. Because essentially China is going through the exact opposite of what the US is going through right now, where they have very good growth, but they have very low inflation. And so the Chinese government is actually trying to stimulate their economy and increase stimulus and the monetary policy, which again is what happened in the US in 2020 and 2021. And so for me, as somebody who is optimistic about the long-term relationship between China and the US, and someone who likes to bounce on opportunity whenever I see it, right now I see this as a good buying opportunity in all Chinese stocks, whether it be internet or technology. But obviously, you have to make sure you do your research and don't just buy into the hype. Make sure you have actual conviction in the companies that you buy and analyze them from a balance sheet and income statement perspective. The two stocks that I'm personally buying are XPeng Motors, which is one of the leading EV companies in China and has been getting absolutely hammered over the past 3 months, even though the business has improved significantly. And then obviously Alibaba, which is probably the biggest e-commerce company in the world, but in the short term, it is facing headwinds as the Chinese economy is trying to recover out of this recession. And as history has always told us, the best time to invest is always during a recession, even though at the moment it always seems like it's the worst time to invest. And that is exactly why most folks never build wealth through the stock market or bonds. But obviously, guys, that is just my opinion, and this is not financial advice. So let me know your thoughts down in the comment section below.